Global financial markets frequently react sharply to sudden shifts in leadership and unexpected geopolitical events across the world. Gold prices experienced significant volatility today after touching the lowest levels seen in a month. The precious metal bounced back very quickly as investors digested new statements regarding monetary policy from the central bank. The price of gold slipped below $4,550 earlier in the trading session. Selling pressure intensified immediately following the initial announcement from the central bank. However, the market found solid support near $4,510 before beginning a steady and gradual upward price climb. The Federal Open Market Committee ultimately decided to maintain the federal funds rate at 3.50 to 3.75%. This marks the third consecutive meeting where policymakers opted to keep borrowing costs completely unchanged. Markets fully anticipated this specific outcome well in advance this particular week. Despite the expected decision, the internal voting revealed significant divisions among the committee members. The final vote was 8-4, representing the highest level of dissent seen within the institution since October 1992. Such deep division highlights growing uncertainty regarding the future path of monetary policy moving forward. Stephen Murren cast a dissenting vote because he favored an immediate interest rate cut of 25 basis points. He has consistently advocated for looser monetary policy during recent meetings. His firm stance contrasts sharply with several colleagues who remain highly concerned about persistent upward pressure on consumer prices right now. Three other active policymakers also dissented, but their opposition stemmed from entirely different reasons. Neil Kashkari, Lori Logan, and Bate Hammack voted against including any language that suggested an easing bias. They argued that recent energy shocks require a much more restrictive approach to keep inflation under strict control moving forward. The official policy statement released by the central bank sharpened its rhetoric regarding inflation. Officials upgraded their description of price pressures from somewhat elevated to simply elevated. The document explicitly highlighted the upward forces stemming from global energy markets and the complex developments unfolding in the Middle East region right now. Jerome Powell addressed the financial media during his scheduled press conference. Many market observers expected this to be his final major public appearance as the leader of the institution. However, he began the session with a very surprising announcement that immediately shifted the tone of the entire economic briefing provided today. The current chairman declared his firm intention to remain on the Board of Governors for an undetermined period of time. This decision effectively means he will not immediately retire after his leadership term officially expires next month. He stated he would leave only when he considers it truly appropriate moving forward. By choosing to stay here, he breaks a long tradition where departing chairs usually leave the board entirely. The last time a former leader remained was Mariner Eccles in 1948. The current chairman explained that his decision was directly motivated by unprecedented legal attacks against the central bank recently. He expressed deep concern that these political and legal pressures are battering the institution. He emphasized the critical importance of conducting monetary policy without taking political factors into consideration. His own separate term as a regular governor officially extends all the way through January of 2028 moving forward. The Department of Justice recently announced it would drop a criminal probe involving the chairman. This investigation focused on significant cost overruns related to the ongoing renovation of the headquarters in Washington. The estimated total price for the massive construction project ballooned to nearly $2.5 billion over time. United States Attorney Jeanine Pirro previously led the controversial inquiry. The central bank attributed the rising expenses to design changes, unexpected soil contamination, and higher costs for building materials. A federal judge previously quashed subpoenas related to this case, calling the effort an unjustified act of pure intimidation against the institution. Despite dropping the immediate criminal charges, the prosecutor warned she would not hesitate to restart the investigation if new facts emerged. She formally referred the matter to the Internal Inspector General for further review. Because of this lingering threat, the chairman stated he seeks complete finality and absolute transparency moving forward. During the press conference, he clarified that he has no intention of acting as a shadow chair. He fully plans to keep a very low profile and respect the authority of his incoming successor. He hopes his presence will serve as a rallying point for staff against outside interference right now. President Donald Trump officially nominated Kevin Warsh to take over the leadership role. The Senate Banking Committee recently advanced this nomination with a 13-11 vote. Lawmakers moved forward only after receiving assurances that the Justice Department probe into the current leadership was essentially coming to an end very soon. Many active market participants believe the incoming leader might implement significant structural reforms. He has previously advocated for eliminating the dot plot and abandoning the practice of providing forward guidance. Some analysts also expect him to push for a substantial reduction in the massive balance sheet held by the institution today. Gold investors closely monitor this transition because less policy predictability often shifts capital toward physical stores of value. When investors consistently struggle to model future moves regarding interest rates, precious metals become a preferred asset. Any perceived loss of institutional credibility could easily drive prices toward new all-time highs completely. The current global economic environment remains highly complex due to the ongoing conflict in the Middle East. The war involving the United States and Iran has severely disrupted global energy transit. A naval blockade effectively closed the Strait of Hormuz, causing oil prices to surge significantly over recent weeks right now. West Texas Intermediate crude oil climbed above $106 per barrel. Brent crude oil also reached four-year highs near $114. This massive supply shock creates a persistent inflationary floor that actively complicates efforts to bring consumer price growth back down to the target level completely. President Trump indicated a strong willingness to maintain pressure until a superior nuclear deal is achieved. He explicitly rejected a very recent Iranian proposal to reopen the waterway while deferring necessary nuclear negotiations. Officials in Tehran responded with stern warnings about unprecedented military action against continued interference with their vessels today. These new geopolitical flashpoints dominate the broader financial landscape right now. The surging cost of energy lifts inflation expectations higher across the board. This dynamic leads markets to price in a monetary path, where interest rates stay higher for much longer than anyone had previously anticipated earlier this year overall definitively. High nominal interest rates combined with anchored inflation expectations result in high real yields. Real yields represent the primary opportunity cost for holding non-yielding bullion like gold. Consequently, investors often sell precious metals when guaranteed returns on government bonds become significantly more attractive in the open market right now today. This precise economic mechanism created a challenging environment for gold throughout March and early April. The precious metal experienced its worst monthly decline since 2013, despite the intensification of the naval blockade. A stronger dollar further complicated matters by making bullion more expensive for international buyers right now completely. During his public remarks, the outgoing chairman noted that officials usually look through temporary energy shocks. However, he explained the current situation is far more complex because it coincides with lingering inflationary effects from previously enacted tariffs. He stated that policymakers want to see these combined shocks fully recede right now. The Monetary Committee must observe the backside of both the energy and tariff impacts before even considering any rate cuts. They expect tariff inflation to decline over the next 2 quarters. Yet the surge in energy costs has not even peaked, yet adding significant uncertainty to their economic forecasts moving forward. A significant development emerged regarding the estimated neutral rate of interest. The longer-run anchor for the federal funds rate shifted upward to exactly 3%. The chairman himself suggested the true neutral rate might actually sit somewhere between 3 and 4% in the current macroeconomic landscape moving forward. This clearly implies that current policy is only moderately restrictive rather than severely tight. For precious metals, this realization presents a formidable challenge moving forward. As long as nominal rates hold steady and inflation expectations remain somewhat contained, real yields will stay positively elevated and pressure commodity prices right now completely. Traders and analysts are increasingly pricing in a massive probability that rates will remain completely unchanged through the end of 2026. The financial markets are now focusing intently on a crucial batch of economic data scheduled for release very soon. These new figures could alter everything right now. The upcoming data nexus includes advance estimates for first quarter gross domestic product and the March personal consumption expenditures price index. These two specific metrics are absolutely critical for determining whether the American economy is entering a dangerous period of stagflation. Stagflation involves low growth combined with high inflation today completely. Such a complex scenario historically provides a very powerful tailwind for gold prices overall. Consensus estimates point to annualized economic growth of roughly 1.8 to 2.3%. However, the Atlanta Fed model recently projected a much lower expansion rate near 1.24% definitively today. This lower economic projection reflects a significant drag from widening trade deficits and much weaker industrial production overall. Meanwhile, the core personal consumption expenditures index is expected to show a monthly increase of 0.3 to 0.4%. This remains the preferred inflation gauge for policymakers right now. On a yearly basis, this specific core price index could reach 3.1 to 3.2%. This level sits well above the official 2% target established by the central bank. Headline inflation may print even higher at 3.5% due to surging oil prices today. If growth prints near 1.2%, while inflation stays above 3%, stagflation is confirmed. In this specific economic scenario, monetary authorities are effectively paralyzed. They cannot cut rates because inflation is too hot, and they cannot raise rates because the broader economy is already slowing down today completely. This policy paralysis eliminates the opportunity cost of holding physical gold because real yields compress during slow growth. Consequently, the metal regains its appeal as a safe haven asset. Investors conclude the central bank is trapped and unable to combat oil-driven inflation without triggering a severe economic contraction right now. The domestic labor market remains in a unique environment characterized by low hiring and low firing. Initial jobless claims have held relatively steady near 214,000. This signals a notable lack of widespread layoffs despite the stubbornly high interest rate environment that persists across the nation right now completely. During his public remarks, the outgoing chair noted that labor demand has definitely softened recently. He attributed part of this slowing pace to a decline in labor force growth. Lower immigration levels and reduced overall workforce participation have significantly contributed to these observed shifts in the national employment landscape completely today. Wage pressure remains a secondary but highly persistent contributor to overall inflation. The Employment Cost Index, which carefully tracks both wages and benefits, is expected to show an increase of 0.8%. Policymakers monitor these compensation metrics closely to ensure inflationary forces do not become deeply embedded right now. The massive infrastructure investments required for artificial intelligence also complicate the economic picture. Major technology companies like Meta, Alphabet, and Amazon plan to spend nearly $650 billion on capital expenditures in 2026. This very aggressive spending keeps demand robust in certain sectors right now completely. Global financial contagion is another very serious risk being evaluated by market participants today. The stark realization that American interest rates will stay higher for longer has boosted the currency overall value. Consequently, major currency pairs and international equity markets have faced significant downward pressure following the committee announcement right now. The euro currency quickly fell to a 3-week low near 1.166 following the decision. Meanwhile, the Japanese yen tested the critical 160 resistance level against the greenback. Other central banks globally are grappling with very similar dilemmas regarding inflation and economic growth right now. The Bank of Canada opted to maintain its policy rate at 2.25%. Officials there explicitly cited the ongoing Iran conflict and trade policy uncertainties as primary reasons for caution. European authorities might even consider interest rate hikes soon to combat their own energy-driven inflation right now. Industrial metals also reacted very strongly to the macroeconomic shifts. Silver prices faced heavy technical selling pressure, dropping toward a three-week low near $70.85. The ratio between gold and silver moved higher to approximately 62.3, reflecting shifting industrial demand expectations today definitively. Despite near-term bearish indicators, the structural case for silver remains remarkably well supported. The global market is currently experiencing its sixth consecutive annual supply deficit. Additionally, central banks around the entire world continue their aggressive reserve diversification strategies, which provides a strong underlying bid for all precious metals today definitively. Technical analysts currently view gold as a strong sell on short-term charts, but a strong buy on longer horizons. This very interesting divergence suggests the current pullback is merely a healthy correction. The metal previously surged from 2,600 to over 5,000 in 14 months right now. For futures traders, securing a daily close above the psychological resistance level of $5,000 remains crucial. Conversely, a break below the solid support at 4,500 could trigger deeper selling. Such a technical breakdown would likely open the door for a test of lower Fibonacci levels completely. Active market participants are currently rotating their financial positions within a defined trading range. The buildup of oversold signals on daily charts indicates that bearish momentum might soon face exhaustion. A technical rebound could be swiftly triggered by any slightly dovish language or further escalation in geopolitical tensions abroad today definitively. The long structural case for precious metals has never been more potent. A massive federal deficit totaling $1.9 trillion provides a foundational floor beneath prices. Institutional players increasingly view physical gold as a necessary conviction-based hedge against continuous fiat currency erosion and potential institutional decay today definitively. Looking ahead, the leadership transition at the central bank will be a defining event for the markets. If policymakers navigate the energy shock successfully without sacrificing autonomy, prices may simply consolidate. However, any real perception of political submission will likely serve as the ultimate catalyst for another major price rally completely. The ongoing Middle East conflict significantly complicates the overall economic outlook. The near-total closure of the Strait of Hormuz has essentially incapacitated the global oil transit system. This massive disruption creates a persistent inflationary environment that directly challenges the disinflationary objectives previously established by the central bank right now completely. Reports indicate that the collapse of Iranian oil production is imminent as storage capacity becomes exhausted. Many currently active wells are being forced into expensive and damaging shutdowns. The United States Navy continues its strict blockade of key ports, effectively squeezing the regional economy to its absolute breaking point today definitively. A critical inflection point approaches very rapidly on May 1st regarding the ongoing conflict. This specific date marks the 60-day limit under the War Powers Act since formal notification occurred. Market participants are watching closely for congressional action, which will inevitably determine the legal status of the war today definitively. Any decisions made by lawmakers will likely drive a massive repricing of risk assets. If the conflict escalates even further, energy prices could break new records and worsen inflation. This scenario would solidify the stagflation thesis and continue to paralyze monetary authorities from taking any decisive easing actions this year definitively. Even as inflation concerns grow steadily, some economic indicators still suggest underlying resilience. Consumer spending still remains somewhat robust, keeping large portions of the economy afloat. However, the services sector has been the primary contributor to growth, while private goods-producing industries have seen noticeable contractions recently right now today completely. Real final sales to private domestic purchasers increased 1.8%. This very specific metric strips out volatile inventory swings and provides a much cleaner read on underlying consumer demand. It clearly indicates that the American consumer is still spending despite the numerous challenges facing the broader economy today completely. The massive infrastructure commitments made by hyperscalers also demand strict attention. Their massive capital expenditures are reaching unprecedented levels, raising legitimate questions about margin sustainability and long-term returns. Investors are carefully evaluating whether revenue growth from new technologies can actually keep pace with these enormous infrastructure costs today completely. The Dow Jones Industrial Average recently failed to reclaim the 48,900 level. It closed near that specific threshold with a decline marking its fifth consecutive loss. This inability to sustain rallies above key resistance levels suggests that extreme caution remains highly warranted across equity markets today completely. Traders must maintain highly disciplined risk management and diversify across asset classes. They should stay attuned to both incoming economic data and rapid shifts in the geopolitical landscape. The interplay of a divided central bank and surging energy prices creates a multifaceted investment environment that requires careful navigation today completely forever. Ultimately, the old rules governing financial markets are being rewritten by the convergence of kinetic war and institutional instability. Gold simply acts as the primary barometer for systemic trust. Its characteristic resilience demonstrates that investors are seriously evaluating the long-term implications of current monetary and political events, today completely forever. The market completely understands that policymakers cannot offer savers a real positive return in this environment. Demand for valuable assets held entirely outside the traditional financial system continues to rise. Physical gold benefits because the stark arithmetic of negative real yields makes holding cash a consistently losing trade today completely forever.